In today's video, we are going to elaborate on why we believe private credit could be a great way of maximizing returns in the fixed income space while managing downside risk and diversifying your alternative investment portfolio. In the current economic context, this type of investments offer a unique advantage that make private credit especially appealing. First and foremost, the state of traditional financial markets has led many investors to seek more stable alternatives with better risk-adjusted returns. Private debt precisely offers that. With relatively low yields on government bonds and volatility in the equity markets, private debt positions itself as a solid investment option, offering yields that normally surpass those of traditional investments. Moreover, the regulatory environment has favored the growth of private debt. Post-financial crisis reforms have restricted banks' ability to lend to mid-sized companies, creating a gap that private credit funds are capitalizing on. This scenario allows investors to achieve attractive returns while supporting the growth of companies that drive the real economy. As seen over the past years, the prevalence of private versus public financings has shown the increasing appetite of borrowers towards private credit that has consolidated as a true alternative to traditional capital markets. And this has led to a significant growth of the market over the past years, which is 7.5 times higher than in 2008. In addition to this, the rise in interest rate has created a favorable environment for private debt investments. As traditional fixed income instruments, such as government bonds, continue to offer relatively low yields, private debt stands out by offering significantly higher interest rates. This could allow investors to achieve superior returns compared to more conventional fixed income assets. The higher yields in private debt could be particularly attractive in a market where investors are seeking to maximize income while managing risk. And talking about risk, we are also witnessing an improvement in credit quality within the private debt market. Companies that are accessing private debt are generally in stronger financial positions than in previous years. This enhancement in credit quality is driven by rigorous underwriting standards and more stringent due diligence processes by private debt funds. Borrowers are generally larger in size, leverage levels have been reduced, and covenants are stronger and LTVs are in a 10-year lows. And these structural dynamics not only provide downside protection, but also ensures a steady stream of income contributing to the overall stability of an investment portfolio. In navigating these complex and uncertain markets, our portfolio performance has been strong. However, we must also consider the broader macroeconomic canvas, especially the rising interest rates environment, which poses a dual-edged sword. While these have benefited our floating rate instruments, there is a consequential impact on the broader market. Higher interest rates significantly increase the financial burden of companies, potentially pushing some of them into stress scenarios. Indeed, the rise in interest rates can precipitate conditions where businesses may face heightened challenges, creating a catalyst for very attractive opportunities in the distressed debt markets. And evidence to this is that the dual-track default rate, including distress exchanges, rose to almost 4% in 2023, which implies the largest amount of distress exchanges since 2010. In conclusion, the combination of attractive returns, enhanced credit quality, and the growing opportunity created for distressed credit markets makes private debt a very timely and beneficial investment option in today's economic landscape, aligning well with the goals of investors seeking both income and stability and also alpha generation.